Do you want to learn how to multiply your money like financial experts do? Then you are in the right place. Stay until the end because in this revealing video, we will show you Robert Kiyosaki's best strategies to help you achieve your financial goals in the current situation. Robert Kiyosaki, author of the famous bestseller Rich Dad, Poor Dad, shows how to apply Gresham's powerful law to boost your wealth, teaching us that financial success goes beyond saving. It is about investing intelligently and strategically. Robert Kiyosaki is a leading financial educator known for his innovative approach to investing and wealth accumulation. One of the fundamental ideas that Kiyosaki has promoted in his work is the practical application of Gresham's law. But what does Gresham's law really mean, and how can it help you build your fortune? Gresham's law, originally coined in the monetary field, posits that bad money drives out good money. In financial terms, this means that when two forms of money circulate simultaneously in an economy, for example, coins of different value or quality, people will tend to hold onto the higher value money and use the lower value one for daily transactions. Kiyosaki has adapted this idea to the world of investing and personal finance. He argues that in the realm of financial assets, we should apply a similar mindset. Retain and accumulate high-quality assets that generate income and long-term growth, while divesting of those assets that do not contribute to our wealth or cause us to lose money. I quote here some of the phrases in which Robert Kiyosaki refers to Gresham's law. In terms of money and wealth, Gresham's law teaches us to identify and retain the best financial assets, those that can multiply our money and generate true abundance. Don't let bad money, like high-interest debt or low-yield investments, dominate your portfolio. Instead, look for assets that will grow exponentially. That is, Robert Kiyosaki reminds us of the importance of applying this law in our financial decisions. By identifying and retaining high-quality assets that fuel our wealth, we can continue on the path to financial freedom and abundance. Specifically, he has been a leading advocate of investing in precious metals such as gold and silver as part of a strategy to protect and grow wealth. This recommendation is based on economic history and the idea of preserving value in the face of inflation and financial volatility. Before moving forward, if you find this information valuable, I encourage you to leave a like and subscribe so you can continue enjoying more content like this. Let's move forward. To understand it better, let's see what the role of gold and silver has been in monetary history. Historically, gold and silver have been used as real money and stores of value for millennia. In the 1940s through the early 1970s, many national currencies, including the US dollar, were backed by gold in a system known as the gold standard. This meant that governments held gold reserves that backed the value of their currencies. Citizens could exchange their money notes for a specific amount of gold if they wished. However, in the 1970s, due to various economic and political factors, the United States government made the decision to abandon the gold standard. The main reason behind this decision was that maintaining the gold standard limited the government's ability to print more money and respond to economic needs in times of crisis. U.S. President Richard Nixon officially announced the abandonment of the gold standard in 1971, which meant that the dollar was no longer backed by tangible gold. Instead, the dollar became fiat money, backed only by trust in the U.S. government and economy. This had important implications. By abandoning the gold standard, the government gained more flexibility in managing the economy, allowing it to print more money to stimulate economic growth or respond to financial crises. However, at the same time, it caused the emergence of inflation risk. Without a tangible backing like gold, the dollar became more susceptible to inflation. It is the widespread and sustained increase in the prices of goods and services in an economy which can erode the value of money over time. For all this, Robert Kiyosaki has argued that investing in gold and silver is essential due to several reasons. Unlike the dollar, since gold and silver are tangible assets and limited in quantity, they tend to maintain their value over time, acting as a solid store of value in periods of economic uncertainty, even when fiat currencies lose value due to inflation as they do today. Additionally, including gold and silver in an investment portfolio provides diversification and stability, reducing overall risk. In contrast, as we mentioned above, fiat money, like the US dollar, is not backed by any tangible assets and can be inflated by governments through excessive money printing. This can lead to currency devaluation and erode its purchasing power over time. On the other hand, Robert Kiyosaki also presents the acquisition of rental properties as an investment strategy that follows the principles of Gresham's law by prioritizing quality assets that generate passive income and have long-term appreciation potential. In that sense, he advises looking for well-located properties in areas with stable rental demand. This means choosing locations that offer good services, access to public transport, and proximity to employment centers, schools, universities, and other services. When applying Gresham's law in real estate investment, we seek to acquire properties that maintain or increase their value over time, providing a constant flow of income through rentals. Additionally, Kiyosaki suggests considering properties that could benefit from future improvements or development in the area, which could increase their value in the long term. The key is to select properties that are solid assets and contribute to wealth creation over time. Invest in profitable businesses. It is another way of applying Gresham's law, according to Kiyosaki. The idea is to identify business opportunities that generate consistent cash flows and have a solid revenue model. He advises looking for businesses with clear competitive advantages, such as unique products or services, a solid customer base, or innovative technology that gives them a solid position in the market. For example, in the world of mobile telephony, a company that meets these requirements could be Apple, having unique products like the iPhone that are highly valued by customers and are willing to pay more money for them. Another example could be Google, the search engine that we all know and use, and which has been named by Charlie Munger as the company with the greatest competitive advantage in the world. But we not only find profitable businesses among large companies, we can also look at smaller companies in our immediate environment, or small businesses that can generate great profitability. By applying Gresham's law in business selection, we seek to invest in companies that can outperform the competition and generate positive returns in the long term. This involves assessing the financial stability and growth potential of the business, as well as the ability to generate consistent cash flows that can be reinvested or distributed as profits to investors. Now let's see how Gresham's law affects the world of cryptocurrencies. Unlike physical currencies that used to be backed by precious metals like gold or silver, cryptocurrencies lack tangible backing. Their value is based on the trust that the community and investors believe in them, as well as their usefulness within blockchain networks and decentralized protocols. In this context, Gresham's law takes on new relevance. In a market where cryptocurrencies with different features and utilities coexist, those more convenient for everyday transactions tend to displace those with more sophisticated functions but less suitable for this purpose. In this way, the most liquid and widely accepted cryptocurrencies are used for daily exchange, while others with more specific applications are held as investments or used in particular use cases. In this way, Bitcoin stands out as an example of good money, as opposed to the concept of bad money that can be applied more generally to other cryptocurrencies. Bitcoin is widely recognized and accepted as a stable and market-leading cryptocurrency, which contributes to its intrinsic value. The trust that the community of users and investors places in Bitcoin, along with its usefulness as a way to store value and carry out secure and decentralized transactions, reinforces its position as good money. In the modern application of Gresham's law to cryptocurrencies, Bitcoin is often preferred for everyday transactions and as a gateway to the world of cryptocurrencies due to its liquidity, wide acceptance, and function as a store of value. On the other hand, NFTs represent a modern evolution of the concept of good money. Each NFT is unique and indivisible, making them uniquely suited to represent unique digital assets such as works of art, virtual collections, and other scarce digital goods. As the world enters an era of digitization and virtualization, the intrinsic value of these assets rises, and their rarity and authenticity become essential. In this context, NFTs often surpass conventional cryptocurrencies in the field of investments and transactions related to art and digital culture. Collectors, investors, and creators find in NFTs a way to confer tangible value on digital items that previously lacked palpable backing and authenticity. These represent a new way of valuing and trading exclusive digital assets in an increasingly digital-oriented world. In short, in this digital age, Gresham's law, which originally applied to physical currencies, takes on renewed relevance, going beyond its initial historical context. The principle that bad money displaces good money fits the relationship between cryptocurrencies and NFTs in an ever-transforming ecosystem. Comparable to bad money, Cryptocurrencies facilitate everyday transactions and serve as an entry into the digital economy. On the other hand, NFTs, comparable to good money, bring authenticity and uniqueness to digital assets, redefining the valuation of online culture and creativity. In this ever-evolving landscape, both cryptocurrencies and NFTs play crucial roles, offering new perspectives on how technology is transforming our traditional notions of value and money. Also remember that investing in assets such as gold, silver, real estate, or profitable businesses can offer protection against inflation and market volatility. These assets tend to maintain their real value even in adverse economic environments or periods of high inflation. Following Robert Kiyosaki's investment principles, including the application of this law, can have significant impacts on wealth accumulation by prioritizing high-quality assets that can preserve and increase value over time. Now tell me, did you know Gresham's law? What country are you from, and what asset do you like best to invest in your region right now? Share your ideas in the comments so we can all benefit. If you like this video and want to learn more about personal finance and investment strategies, be sure to subscribe to the channel and turn on notifications so you don't miss future content. Thanks for your time, and see you in the next video.